Hello everyone, Steve Lentz here with Discover Options. It is March 27th. It's Sunday. It's Easter actually. Happy Easter to those celebrating. I'd like to do the market likelihood report today in the Prepared Mind presentation. I want to alert you first to Frank Fahey's Prepared Mind blog entry. It'll be as of the March 28th, of course, which is Monday. But he has a lot of good comments there, and I want to alert you to the area where in the blog he has a list of double calendar candidates with earnings coming out soon on these stocks. You could see on the right side the date, and then the column just to the left of that, you have BMO or AMC after the market close or before the market open. Take a look at that. Looking at the market action most recently in the S&P 500, we see that the price action is above the 65-day moving average, so it's definitely trending upward, but we've had a pullback here. So we look at the price action where the high was lower than the previous day's high. The low was lower as well. The close, the previous day was lower, but then this most recent day, the close was higher than the open. In addition, we are in an overbought situation with the stochastic 15.3 being above 70. So this is a very unique situation. We're in overbought territory. We're trending up, yet we've had a pullback. Okay, we've had a pullback where you have a bar making a lower high, lower low, yet the open is lower than the close. Kind of interesting. Not too many setups like that. So the question here is when we go back to January of 2000, how often has this same scenario occurred, and what did the market do at that point? All right, what did it do whenever that setup occurred? What happened? All right, and is there an edge? So what we like to do is an edge analysis that gives us our likelihood report, and it involves three things. First, we understand the historical distribution of price. Then we look at the price distribution after that setup occurs, that technical scenario occurs. A very unique setup this time. Okay, if the two are different, there may be a potential tradable edge if the distributions are different between historical and then what this setup has for us. So let's take a look first at the historical distribution of price. We do this by using volatility bands, 5, 10, and 15 days set in the future, 5, 10, and 15 days, 15 bars. Each band is set one standard deviation from the close. We're using a 20-day historical volatility. We call it statistical here at OptionView and Discover Options. And these are normally distributed. Here's just a quick example. 10-day bands set one standard deviation away. The question here is, in terms of distribution, will price from this close move up and touch the upper band, go down and touch the lower band, or will it stay in the middle? All right, in this case, it went up and hit the upper band, just actually within the next day. Now look at the most recent close you see there in the middle of the screen. From that close, is price going to go up and hit the upper band, go down and hit the lower band in the next 10 days, or will it stay in the middle? And what you see is that price actually kind of stayed in the middle. It tried to come down and hit the band here, but close but no cigar. So this goes under the category of it hitting neither band. All right, so what we like to do is from every close, we're going to record how often price struck the upper and the lower 5, 10, and 15 day or 15 bar bands from every close. And so going back to January of 2000, that's a lot. That's over 4,000. So here we have the distribution as of 325. All right, the SPX, over 4,000 closes, over 4,067 closes going back that far. It hit the upper 5-day band 29.5% of the time, the upper 10-day band 23.2% of the time, the upper 15-day band 22.9%. Then on the downside, it hit the lower 5-day band 30%, the lower 10 29.6%, and the lower 15 32.4%. So this is the historical distribution. It's hitting the bands, you could see, roughly between 23 to 30% of the time. It's hitting one of those bands. Now, what we're going to do now is go and look at the distribution after our particular scenario, the one we just had. All right, so here we have the setup. Okay, here we have the setup that we, the most recent with the SPX. Okay, and you can see the bands set up right there. And what we're going to do is actually look at the distribution as of the close, and then we're going to pretend that price exceeded the high. All right, and we're going to examine what was the distribution if it went above the high of the most recent bar. We're going to look then at what the distribution was if the price went down below the low of that recent bar, the red one there, okay? So we're going to look at distribution in 3 different ways, and here it is. You have the historical distribution here. You see that? Okay. We have it at the close as well. Now take a look at the close and look at the upper 5-day band at the close, 22.4. Now compare that up above to the historical distribution of 29.5. What does that mean? That means that just sitting there as of the close, all right, we would expect price to not move up and hit the upper 5-day band near as often. Historically, over 76 times that it made this same setup, it hit the upper band 22.4% of the time, whereas historically it's normally at about 29.5. So look at the other ones. The upper 10, the upper 15 are both below what the historical distribution is. Look at the lower set of numbers. All 3 of those are underneath the historical distribution as well. So it seems that just as of the most recent close, that this setup would yield an expectation that it's going to stay in the middle of the bands a little bit more often than what historically it has in the past. Now, if price goes above the high, all right, compare those numbers to the historical as well, and you'll see that in all 6 of those cases, it was underneath historical, actually by quite a bit more. So if it goes above the high on Monday, well, then we would expect even more so that price would stay between the bands. Now, if it goes below the low, now the numbers creep up and they're actually higher than the historical distribution, particularly on the upside. Look at that. Most interesting, if price goes below the low, okay, it would appear then that it has the propensity to actually go up and hit the upper bands more often than historically. Do you see that? Right down here, these numbers right there, 30, 35, 40%, those are typically higher than what the historical distribution is. Very interesting. So watch what happens here on Monday. All right, let's now take a look. Those of you that trade options, you should know that the implied volatility of the option prices are now higher than the 20-day statistical volatility. It just curled upward. And what we like to do is run the same distribution report using, instead of statistical volatility, using implied volatility. And we adjust for the skew, the vertical skew that you'll see in the SPX options. And we use the SIBO's skew, SKEW symbol, to help us adjust the VIX, or adjust the implied volatility levels so that we have a volatility that occurs to the upside, all right, which is lower than what the volatility is for the market that occurs when it goes down. And at the bottom of the report, you'll see the statistical volatility we used in the previous report. We have the upward volatility and the downward volatility contributing to these bands. Now, if the implied volatility is higher than statistical, the bands are going to be wider apart, correct? If the bands are farther away from the close, using implied volatility, then the incidence of price striking those bands is going to be less than if we use statistical, correct? And that's what you see here. Look at the historical distribution at the top. 21, 15, 14, 17, 18, 20. You see that at the top. Same 4,067 signals. Those numbers are lower because the bands are wider. Okay. Now, looking here at the distribution at close, if we exceed the high, if we exceed the low, you'll see a similar pattern. Although if it exceeds the high, boy, look at that. You're now in single digits on the upper bands, at least on the 10 and the 15. And on the lower band on the 5, you're down in single digits now on some of these distributions here. So selling premium out of the money using these volatility levels might be something to look at. So for in terms of butterflies and condors, it looks like a pretty decent environment. At least historically, it appears that there is an edge that would favor those strategies. So just here, before we go to that, look at the bottom left. Look at the upward volatility skew adjusted 13.3. Downward is 16.1. So something you might consider is a condor on the upside volatility using a 13.3. On the last close, you'd go out to around the 2100 there in April, something like that. On the downside, you would use a 16.1 vol that you see up here. Okay. And when you run that condor through and analyze it, this is kind of what it looks like. And many of you are very astute and you understand what the modeling is here. At Option View, we specialize this in spades. But what you can see is if the price goes out and hits the borders, hits the short strike, you can kind of then model how much you would lose and gauge it regarding the probabilities of it doing so. Remember, we're in the single digits on some of these. And going out that far, let's go back, going out to 15 days. Okay, the upper 15 and the lower 15. Okay, if at close or if it exceeds the high, you're in single digits well under 10%. If it goes down below the low, now you're at 10, even 20 there on that one. So just keep that in mind when you're looking at the probabilities of it striking these borders or these short strikes. It would appear there's a nice little edge for you there. Okay. Oh, and there it is. Yep, excuse me. There we go. And then what you would do is just run those numbers out. You know, it looks like if it goes down and hits the lower edge, you would roughly lose 1.5 times what you're trying to make. And if it goes up and hits the upper short strike, looks like you would lose 2 times what it is you're trying to make at expiration. But when it only hits that upper level, 5-6% of the time, you can see that there's a clear edge. Folks, thanks so much for joining me today. Hope you have a great coming week here in trading. Be safe, take care, have a great rest of the day. Bye-bye.